Welcome to lecture 23 of Corporate Finance. In this video, we are going to start a new chapter, which is Project Analysis and Evaluation. So let's explore the contents that we are going to discuss in this chapter. First, we are going to understand what is forecasting risk. This would be understood in terms of cash flow estimation, right? Then we are going to explore certain techniques. First one of those techniques would be scenario analysis, then sensitivity analysis, and then we are going to explore different types of break-even analysis. So let's get started with forecasting analysis. So let's go through the definition. The possibility that error is in the projected cash flow will lead to an incorrect decision. And this forecasting error is also called estimation error or estimation risk. So what this means is that if you remember that to calculate NPV, remember if we need to start a project, we would go through certain capital budgeting techniques, right? So one of the technique is, let's just say, NPV, and it is also similarly true for other techniques also, but I'm just taking an example of NPV. So it is not to say that forecasting risk or estimation risk is just pertinent to NPV. It is related to all the other techniques as well. Okay, so how do we come about this NPV? We first estimate cash flows. And remember, to estimate cash flow, we would have the estimates of sale, the estimate of variable cost, the estimate of fixed cost, and other revenues and cost estimations. So what essentially we were doing is that we were estimating cash flows, and then using those estimated cash flows, we were estimating NPV. And using that estimated NPV, we were taking certain decision whether to start that project or not. So obviously, if our cash flow estimation, if we estimated that we incorrectly estimated, overestimated sales. So for example, if we estimated that our sale would be 1000, but it actually turned out to be 500. So we overestimated the sales. Or if we estimated that our variable cost would be 50 rupees per unit, but actually it turned out to be 100 rupees per unit in the actual scenario when we started the project. So we underestimated the variable cost. But what would happen if we underestimated the variable cost or overestimated the sales? This would lead to an incorrect NPV, and hence we would have an incorrect decision. And why this incorrect decision is happening? It is just because we somehow had flaw in our estimation, right? So this is what forecasting risk is, that there is certain possibility that we would make some error in this cash flow estimation, right? We need to see how do we reduce that risk. We need to see how do we what decision we need to take about to handle this forecasting risk. Okay, so forecasting risk would be high if the difference between the projected and the future cash flow is high. It simply means that our projected sale was 1000 and the actual sale turned out to be 500. So the difference between the projected and the actual cash flow, actual sales or actual expenses, and the projected expenses would be the forecasting risk. So we need to determine certain ways to minimize this forecasting risk, and this is where certain analysis would come. So we would see scenario analysis, which is also called what if analysis. Then we would explore sensitivity analysis, and these two analyses would help us in minimizing the forecasting risk. So first, scenario analysis. What is scenario analysis? The determination of what will happen to NPV if we ask the what if question. Okay, what this means is that, let's just say we said that our sales would be 500 units, right? And based on this estimated sales, we calculated our NPV, right? Let's call this base case or base scenario. Now someone asks us that what if instead of 500 units of sales, our sales turns out to be 200 units? Then what would be the NPV? Let's call this worst case scenario. The other guy in the room asked us that what if our NPV, what if our sales is 1000 unit? Then what would be the NPV? Let's call this a best case scenario, right? So now you have got an idea that what we are doing is that we are calculating NPV or IRR or some other estimation using different scenarios. This is what we call scenario analysis. Estimating NPV or other estimation technique for different scenarios. So determination of what would happen to NPV, this NPV is written just for example, but it can be anything other than NPV when we ask what if question. So first we estimate the base case as we did here. Then we investigate the impact of different assumptions about the future on our estimate. So then we investigated the impact of assumption that if the units are 1000 or 2200 on the future NPV. So let's have an example. Calculate the total cash flow and NPV if the discount rate is 12%, depreciation is 40,000, tax is 35%, and the discount rate is 12%, project life is 5 years, and our initial investment, this II stands for initial investment, is 2 lakh rupees. So what we did is that we have a base case, then we have a worst case scenario, then we have a best case scenario. Imagine in base case we assume that there would be 6,000 units of sales. In worst case we assume that there would be lesser sale. In best case there would be higher sales. Again, in base case the price of that unit would be 80 rupees when we are going to sell it. In worst case the price would decrease. In best case the price would increase. Similarly, our estimate of variable cost, in worst case the variable cost, this should be rather the other way around, the variable cost should increase, and in best case the variable cost should decrease. So what is happening here is that we are taking a whole case, right, rather than individual aspect of the case. So we are developing whole scenarios and then we are going to estimate the NPV for those whole scenarios. So for example, we would draw an income statement, and then based on this income statement we would calculate the NPV. So we would have these different scenarios and we would calculate NPV, IRR and other estimation techniques for these different scenarios. But remember, when we change the scenarios, all the variables, this is variable 1, which is the unit of sale, this is variable 2, which is the price, this is variable 3, this is variable 4. What do we mean by variable? These are different aspects, different factors of our projections, of our estimations. So in scenario analysis, when we have different scenarios, we have this base case, this worst case, this best case. all the variables would change rather than only changing a single variable. Now, what do I mean by all the variables and single variable? When we go for sensitivity analysis, it would become much more clear. What do we mean by all the variables? But remember, in scenario analysis, all variables would change, right? So we didn't just change the sales, unit sales from 6,000 to 5,500. We also changed the price in different cases. We also changed the variable cost in different cases. We changed all the variables. Okay, let's move towards sensitivity analysis. This is somewhat similar to scenario analysis. It is a variation of scenario analysis that is useful in pinpointing the area where forecasting risk is especially severe. The basic purpose is to, with sensitivity analysis, to freeze all other variables except for one. Now you will get an idea, and then see how sensitivity analysis estimates out NPV with the change of just one variable. So let's move towards an example. So investigate what happens to NPV when only one variable changes, that is sales. So this is sensitivity analysis. So in previous examples, when we were discussing scenario analysis, we would all change sales as well as variable cost, fixed cost. We would also change price. But in sensitivity analysis, we are just going to check the effect of sales on NPV. We would keep all other things constant. We would keep all the variable cost, fixed cost, and the price constant. We would just change the sales. In scenario analysis, we didn't kept other variables constant. We kept changing all the other variables. But in sensitivity analysis, we would keep other variables constant, only change one variable. Okay, so this is the same example. You would see that in this case, we want to investigate what would happen to NPV if we only change sales. So we are just changing the sales. The other variables are kept constant. So price is constant in all the cases, variable is constant in all the cases, variable cost is constant, fixed cost is constant. We have just changed the sales. So we just want to know that how much this NPV is sensitive to the change in sales, the sensitivity of NPV to the change in sales. This is what sensitivity analysis would tell us. One more example. So here, if we have base case, we are just checking the effect of sales on NPV. So we see that if in base case our sales is 6,000, our NPV would be $15,000. In worst case, if sales is 5,500, our NPV would be negative. In best case, sales is 6,500, NPV would be higher. So obviously, we would see that NPV is quite much sensitive to sales. So we must be aware that if we have estimated that our sales would be 6,000, then we must be aware that if the sales drops down to 5,500, then our NPV becomes negative. So imagine if this was the case and this was the case, then we would accept this project, but in this case we should reject the project, right? But let's just see the effect of fixed cost. Now we have kept the sales constant, but we have just changed the fixed cost. You would see that even in the worst case scenario, the NPV remains positive. So what do you think? NPV is more sensitive to changes in fixed cost, or NPV is more sensitive to changes in sales? Obviously, NPV is more sensitive to changes in sale, right? Because the highest is 39,000 and the lowest is -8. So the difference is almost 50,000, right? So the higher the difference in a lower and the higher range, the higher would be the forecasting error, the higher would be the sensitivity. So in this case, the forecasting risk would be higher with respect to sales, but the forecasting risk with respect to fixed cost would be lower. So we have discussed sensitivity analysis and scenario analysis. Just to recap, in scenario analysis, we change all the variables. In sensitivity analysis, we just change one variable, and see what would happen to the NPV when we just change one variable. How much sensitive NPV is with the change of just one variable. Okay. Before we move forward, I would like to make sure that we understand what variable cost is and the other costs as well. So variable cost is the cost that changes when the quantity of output changes. So you have already studied this concept in other subjects. So what this means is that if you are producing, so for example, if variable cost is 3 rupees per unit, so this variable cost would only increase if your production increases, if the quantity of output increases. If quantity of output is 0, then this variable cost would also be 0. Right? Similarly, fixed cost is that do not change when the quantity of output changes. So this variable cost might be the cost of raw material. So if we increase production, raw material demand, raw material need would increase. But this fixed cost can be the rent of the factory. So whether we have production or not, we would have to pay the same amount of rent. It isn't going to decrease or increase with the level of production. So this becomes the fixed cost, the cost that do not change with the change in the output. Then we have total cost, which would be the combination of variable cost and the fixed cost. We also have marginal or incremental cost. What this is that if sales is 0, right? Sorry, if production is 0, output is 0, then our total cost would be equal to fixed cost, because if production is 0, variable cost would be 0, right? But if we increase the production by just 1 unit, by how much our total cost would change? This is called marginal cost or incremental cost. The increase in cost for every 1 unit increase in production. Then we have average cost. This average cost is different from incremental cost. Average cost is just the mean of different costs, right, at different levels. So this isn't marginal or incremental cost. This is just the average. So just to make it clear, to distinguish the incremental from average cost, you must remember this. So once we have understood these cost concepts, we can move towards our next topic, which is break-even analysis. And we have seen break-even analysis before in different subjects, but this one is different. We are going to explore different types of break-even analysis. So it is the popular and commonly used tool for analyzing the relationship between sales volumes and profitability. There are a variety of different break-even analysis. We have accounting break-even, the cash flow break-even or cash break-even. Then we have financial break-even, or we can also call this NPV break-even. So most of the time, when we say break-even, then most of the time the student would say that when revenues is equal to expenses, or when there is no loss or no profit, right? Normally what they are referring to is the accounting break-even, right? When revenue is equal to expenses, when there is no profit, no loss, that is the accounting terminologies, right? So normally they are referring to accounting break-even, but so we would explore these other break-even as well. So first, starting with the accounting break-even. Accounting break-even occurs when the net income is 0, right? So net income is an accounting term. In other words, the sale level that results in 0 project net income. So when the net income becomes 0, that the quantity, the sales level at which a net income becomes 0 would be called accounting break-even. So we need to find that quantity, that Q, that level of sale at which net income would become 0. To find that level of sale, Q is equal to fixed cost plus depreciation divided by P. P stands for price, which is selling price, sale price, minus the variable cost. So for example, if fixed cost is, we would have an example in next slide. So suppose this ABC Corporation is considering whether or not to launch its new product. The selling price is 40. This would become RP. The variable cost will be about half of the selling price, which is $20. This would become RV. And the fixed cost is 500. This would be FC. The total investment would be 3,500. This amount would be depreciated using straight line method to 0 over 5 years. So our depreciation would be 3,500 divided by 5. And the salvage value would be 0. There would be no working capital and the 20% required rate of return. So the total unit produced is in 5 years would be 425 and the yearly production would be 85. So this number is important. We should remember that this company have estimated that its sale or production would be units per year. Okay, so our formula to find accounting break-even is Q is equal to FC, fixed cost, plus depreciation divided by P minus V. So if we plug the values, so fixed cost is 500, depreciation is 3,500 divided by 5, it would be 700. So we add 700 divided by selling price is 40 and variable cost is 20. So the answer is 60. So what this 60 means is that if we have a sales of 60 units, then our net income would become 0. So if the company estimates that they can at least sell 60 units, then according to accounting break-even analysis, they should go for that project. So the company is obviously, we saw in previous slide, the company is estimating that they can sell or produce 85 units. Let's just say sell 85 units. Then obviously there is a quite good cushion for the company. Even if they do not sell 85 units, if even they sell 70 units, they would be in profit, right? So they have quite a lot of cushion, they have quite a lot of room. The forecasting, if even their forecast is 85, if that forecast is wrong and the actual sales turn out to be 70 or even 65 or even 60, that wouldn't be bad for the company. So what I mean to say is that this accounting break-even analysis would also help us in forecasting risk. So if our projected sales is 85 and the accounting break-even is 60, we have quite a lot of room, and if the things go sideways, if our forecasting is not accurate, if the forecasting risk is high, even then we would be good enough. This brings us to second break-even, which is cash flow break-even. So cash flow break-even means when operating cash flow becomes 0. So remember, we had OCF, which was equal to EBIT plus depreciation minus taxes. So we need to find out at what quantity sales this OCF would become 0, or the sale level that results in 0 operating cash flow OCF. So this is exactly the same. The formula is Q is equal to FC divided by P minus V. So if we take the same example as we had in previous question, our fixed cost was 500. Our price was $40 and the variable cost was 20. So the Q would turn out to be 25. So this means that if we can sell 25 units, then our cash flow would be at break-even level. That means we would have 0 OCF if we can sell 25 units. Lastly, and the most important break-even analysis is the financial break-even analysis. This financial break-even analysis tells us the quantity sales at which NPV would be 0. And remember, financial managers are mostly interested in NPV, the net present value, rather than just the net income. So we need to find out the quantity sale at which NPV would become 0. In other words, the sale level that would result in 0 NPV. That's why, if you remember, I called it NPV break-even. So to find Q, we need to have fixed cost plus OCF. This OCF is OCF static, and what this OCF static means, the OCF at 0 NPV. So what would be the OCF at 0 NPV? We would need to find out that, and we would add it to the fixed cost. To find this 0 OCF, remember the formula to find NPV was NPV is equal to cash outflow, that is cash outflow at 0.0, plus OCF, operating cash flow, multiplied by the annuity factor. This annuity factor is nothing but if you remember the annuity concept and the formula to find the present value of annuity, which was C into 1 minus 1 divided by 1 plus R raised to power N divided by R. This was the formula to find present value of ordinary annuity. So this part of the formula, excluding the C, is called the annuity, present value annuity factor. So we just need to calculate this part, right? So okay, so if NPV is equal to minus cash flow, that is cash outflow, plus OCF into annuity factor, this would be cash inflow. And if we know that we need to find the OCF at 0 NPV, then it would be 0 is equal to minus CF plus OCF into annuity factor. We need to solve for OCF, so we transfer CF towards the left side of the equation. We would be left with OCF. We need to also transfer this annuity factor, so this would become annuity factor. So OCF is equal to initial investment or cash outflow divided by the annuity factor. So let me clear this slide. So in previous example, to solve this, we first need to find OCF. In previous example, and we just saw that OCF is equal to initial investment, which is cash flow at time 0, divided by the annuity factor. Initial investment in previous example was 3,500, and the annuity factor for 5 years would be 1 minus 1 divided by 1 plus 0.20 because the risk-free, the required rate of return was 20%. If we go back to the example, raised to power 5, because this project was for 5 years, we find the annuity factor, which would be 2.9906. If we solve for this, we get an OCF of 1170. So if we plug these values in this equation, we know that fixed cost was 500, OCF is 1170, we just calculated that. 40 is the price and 20 is the variable cost. The answer would be 83.5. So what this 83.5 means, let's just say 84. This means that the company needs to sell 84 units to have a financial break-even, to to have an NPV of 0. So if the company would sell more than 84 units, then the company would have a positive NPV. If the company would sell less than 84 units, then the company would have a negative NPV. Obviously, the company would want a positive NPV. So what do you think now about the forecasting risk? Remember, the company projected that it would be able to sell 85 units per year. This was the projection in the question, yearly. And we are saying that at 84, the NPV would become 0. Do you think the forecasting error is higher in this case or not? It is higher. Why is that so? Remember, if this is our forecast, we have forecasted that we would be able to sell 85 units. But imagine if our forecast, there is some error in our forecast. Obviously, there would be some error. Our forecast would not be exact. But even if our forecast, if the actual sales become 80, right? It is just a small change in our sales, then our NPV would be in negative, right? It would be less than 84. Remember, if we sell less than 84, then our NPV would be negative. So now you get an idea that in this case, the forecasting risk is quite high. Why? Because we think that we will be able to sell 85 units, and 84 our financial break even is achieved. So there is no room for the error. So the risk is higher in the case when our projected sale is somewhat nearer to the financial break even. So if now you compare, our accounting break even was 60, our cash flow break even was 25, and our NPV break even is 84. So from financial perspective, we are interested in this one. Cash flow would always be the lowest quantity, right? So we will continue this discussion in our next lecture.